So I'm currently staring at a signed heads of terms agreement.
Oh, wow. Congratulations.
Thanks. I mean, the champagne is literally chilling in the fridge right now. I am about to sell this business that I have, poured my blood, sweat, and tears into for the last decade. But honestly, my stomach is just in absolute knots.
Right, because of what comes next.
Exactly, because
Yeah.
the buyer just casually dropped two terrifying words on me. Due diligence.
Ah, yeah. The dreaded DD.
Yeah. And so for the next 15 minutes or so, I really want you, the listener, to just pull up a chair. Sit right here at the table with us as the third person in this deep dive into our source material. Because my role today, I am playing the part of a UK business owner in a state of sheer panic, utterly convinced that a team of ruthless corporate auditors is about to tear through my life's work.
And you know what? It is completely rational to feel that level of overwhelm. I mean, you are transitioning from being the undisputed CEO of your domain to feeling like, well, an asset under a microscope. So as the business sale advisor in this scenario, my entire mission today for you and for our listeners sitting here with us is to break down exactly how they look through that microscope. Because due diligence is a completely manageable, entirely normal, and absolutely necessary part of a responsible business sale. It's a mechanism for risk management, not a personal attack.
See, but it definitely feels personal. When someone says they want to perform, due diligence on something I built from scratch,
Yeah.
it sounds like an investigation, like I'm a suspect hiding something.
I get that. I really do.
So before I completely panic, call my lawyer and just blow up the whole deal, can you just define what this actually is in plain English?
Gladly. I mean, in plain English, due diligence is simply the buyer checking that everything you, the seller, have told them about the business is actually true.
Okay.
That is the entire core of it. It's a mechanism for uncovering reality. You've presented a picture, right? You've told them the business makes a certain amount of profit, holds certain assets, maybe has specific reliable contracts. Due diligence is just the verification of those claims.
Okay. Verification. I think I can handle verification. But I mean, they're sending in squads of accountants and lawyers to do it.
Let's use an analogy to ground this a bit. Imagine you are buying a house.
Right.
You wouldn't just look at the freshly painted living room, shake hands with the seller, and hand over your life savings, would you?
No, obviously not.
Exactly. You would get a professional survey done before exchanging contracts. You want an expert to go up into the attic, check the foundation, look for dampness or structural issues. Well, a business buyer is doing the exact same thing. They are checking the structural integrity of the business before committing.
I understand the house survey analogy. I really do. But a house is bricks and mortar. My business breathes.
How do you mean?
Well, a house doesn't have 30 employees who might get totally spooked if they see strangers in suits poking around. A house doesn't have complex cash flows or key clients who might decide to leave if they don't like the new owner. This just feels way more invasive than looking for damp in an attic.
Which is exactly why the microscope is so powerful and why you have to separate your personal emotional investment from the professional transaction.
That's easier said than done.
Oh, absolutely. But the buyer isn't looking to judge your past management style or your leadership philosophy. They are strictly looking for what the industry calls black holes.
Black holes, like they...
Like hidden liabilities, unforeseen tax issues, or compliance failures. If they are spending a significant amount of money to acquire your life's work, they have a fiduciary duty to their own investors or their bank to look under the floorboards.
Okay. Uncovering reality. Checking the floorboards for black holes. So, I mean, as long as I can show them my bottom line profit has grown in every year, the financial check should be a breeze, right?
Well, not exactly. Profit is just the headline.
What do you mean?
So the sources we're relying on break due diligence down into three main categories. And the first is financial due diligence. This is where the buyer's accountant steps in. And they are looking at the quality of earnings.
Quality of earnings. Isn't a pound of profit just a pound of profit?
On paper, maybe.
Yeah.
But they want to ensure there are no unpaid VAT, your value-added tax, or payee, your payroll tax issues just hiding in the background.
Uh-huh. Okay.
Let's look at the mechanism of your balance sheet for a second. Specifically, your accounts receivable. If you claim you have £100,000 owed to you by clients, but their accountant digs in and notices that 50% of those unpaid invoices are over a year old.
Oh, I see where this is going.
Right. Those aren't realistic assets anymore. You probably aren't ever going to collect that money. Financial due diligence recalculates those realities so the buyer knows exactly what cash will actually flow.
Okay, so the accountant verifies the money is actually there and likely to stay there. But what if the money is there, but the contracts generating it are just an absolute mess?
Exactly the right question, because financials are just a snapshot of the past and present. Your contracts, on the other hand, dictate your future. That's why we immediately move to the second type, which is legal and regulatory due diligence. This is the buyer's lawyer's domain. They are looking at the contractual foundation of the business. Like, are your employment contracts actually compliant with current legislation? Do you have proper restrictive covenants in place?
By restrictive covenants, you mean the legal clauses that stop my top salesperson from just, you know, quitting the day after the sale and taking all my best clients to a competitor.
Precisely. If those clauses don't exist, or if they're poorly drafted and legally unenforceable, the buyer is taking on massive risk. The lawyer will also check who actually owns the intellectual property.
Wow. Yeah.
They will scrutinize property leases too. For instance, they look for dilapidation costs. That's a liability where a commercial lease requires you to pay to return the property to its original empty state when the lease actually ends.
Oh, man, that could be tens of thousands of pounds easily. But wait, how does a lawyer actually find all this? If I have 10,000 pages of client and supplier contracts, they aren't just sitting there reading page by page with a highlighter, are they?
Often, no. They use specialized software to index and scan your documents specifically for things like change of control clauses.
What's a change of control clause?
It essentially says, if the ownership of this company changes, this contract is null and void. If a lawyer finds that in your biggest supplier agreement, the buyer needs to know they might lose their entire supply chain the exact day they buy you.
Right. Wow. So legal makes sure the foundation is solid and the assets are protected. But I guess none of that matters if no one actually wants what we're selling tomorrow.
Which is why commercial due diligence is the final crucial piece. The buyer assesses the market, the competitive landscape, and most importantly, the sustainability of your customer base.
You know, this actually reminds me of a real-world story from our source material. There was an IT services firm that almost got bought, and it looked fantastic on paper. The profits were huge, the legal contracts were ironclad. But during the commercial due diligence, the buyer found out that 60% of their entire revenue came from just one single enterprise customer.
Yes. And what's fascinating here is how that beautifully illustrates the concept of systemic risk.
Because if that one customer leaves,
If that one customer decides to switch providers next month, the entire business collapses instantly. You haven't bought a business at that point. You've bought a massive, ticking liability. Uncovering that exact kind of fragility is the entire point of commercial due diligence.
okay, so financial, legal, and commercial. I think I understand the what and the WHY now. But from the purely practical standpoint, how does this actually begin? Do they just back a truck up to my office and start loading filing cabinets?
No digital trucks either. It starts with an information request. The buyer's lawyer will send over a very detailed list of questions and document requirements.
And this is the part that sounds completely overwhelming to me. Looking at the standard requirements from our advisory sources, they want 3 years of accounts, all my VAT returns, corporation tax returns, management accounts, up to the current month.
That's standard, yeah.
Plus, every single employment contract, every key client contract, supplier agreements, property leases, and details of any past or pending legal disputes. I mean, I'm trying to run a company here. Gathering all this sounds like a second full-time job.
It does sound like a mountain of paperwork. And they don't want it over some disorganized email thread either, because that's a security nightmare. This brings us to the concept of the data room.
The data room. Honestly, it sounds like a windowless basement where they lock me in with a single light bulb and interrogate me about my 2022 tax filings.
I promise you, the reality is entirely digital. A data room is a highly secure, heavily organized online platform. Think of it like a specialized enterprise-grade cloud drive.
Yeah.
Your legal team sets it up, and all the documents from that information request are uploaded and indexed into specific folders. The buyer, their lawyer, and their accountant are given restricted access to view the files.
So it's all in one place.
Exactly. It creates a single source of truth for the entire transaction, and it tracks exactly who viewed which document and when. There's usually even a built-in Q&A module where their lawyers can ask a specific question about a specific PDF, and your team can answer it right there in the system.
Now, if you're listening to this and you're maybe 3 years away from selling, this is actually great news for you. Because if a business owner is already highly organized, if they already have all their contracts digitally filed and their accounts up to date, this terrifying information request is really just a matter of dragging and dropping files into a folder.
You've diagnosed the exact friction point right there.
Yeah.
It is entirely a matter of preparation. It only feels like an impossible mountain if you are disorganized.
Right.
Sellers who run a tight ship operationally find this stage incredibly straightforward. The data room is simply a mirror reflecting how well you've kept your house in order.
But let's look in that mirror for a second and assume it's not perfect. Because let's be real, no business is. What happens when they find a slow leak in the plumbing? An old tax mistake, a bad contract, a compliance issue I just completely missed. Does the buyer just slam their laptop shut and cancel the deal?
Usually, no. That's a massive misconception that causes sellers so much unnecessary grief. Uncovering issues during due diligence does not automatically kill the deal.
It doesn't.
No, because both sides have already invested heavily in legal fees and time, the buyer still wants to acquire you. What usually happens is that it changes the quantum, which is the industry term for the price, or it changes the deal structure.
How does that price renegotiation work mathematically, though?
Let's go back to the financial due diligence example with your inventory. Say you agreed on an upfront purchase price of £2 million based on your balance sheet.
Okay.
But the buyer's accountant physically audits your warehouse and finds that 50,000 pounds of your stock is completely obsolete. You know, old tech components that no one buys anymore. Right. So the buyer will come back to the negotiating table and say, look, we still want the business, but these assets aren't worth what you stated. We need to reduce the upfront cash price by 50,000 pounds to reflect reality.
Man, if they drop the price like that, shouldn't I just walk away out of principle? Or at least aggressively defend my accounting?
Absolutely not. Getting defensive is one of the biggest tactical mistakes a seller can make. You have to realize that you are entering a second phase of negotiation based on cold, hard facts.
Right.
The worst things you can do are respond with hostility, provide incomplete information, or try to actively hide things.
Because they're going to find it anyway.
Exactly. There's a brilliant example in the advisory sources regarding a care home acquisition. A buyer was looking at this facility, and financially it was flawless. High occupancy, great turnover.
So perfect.
But during regulatory due diligence, the buyer's legal team discovered that the Care Quality Commission, the CQC, which regulates health and social care in the UK, had recently flagged multiple compliance issues at that home.
Oh, wow. And if the seller tried to paper over those cracks and hide that CQC report?
It destroys all trust instantly. If a buyer catches you hiding a regulatory violation that could literally get the business shut down, they will instantly assume you are hiding financial fraud too, and they will walk away.
That makes total sense.
Honesty is your best tool. If you know there is a pending dispute with the supplier, tell the buyer up front. Put it in the data room on day one. It builds trust, and it allows your legal teams to figure out a mechanism to manage the risk. Something like an indemnity.
An indemnity? How does that work?
An indemnity is essentially a contractual promise. You, the seller, agree to reimburse the buyer on a pound-for-pound basis if a very specific risk actually costs them money down the line.
Okay.
So if that supplier dispute turns into a 10,000-pound lawsuit after the sale, you've legally promised to cover that 10,000 pounds. It allows the deal to proceed because the buyer feels financially protected from your past mistakes.
Okay, honesty is the best policy. And we can use legal mechanisms to protect the deal. I can do that. I'll put everything in the data room, the good, the bad, and the ugly.
Yeah.
But I still have a company to run. I can't have this buyer poking around in my data room for the next 2 years. How do we survive this process without it completely paralyzing my day-to-day operations?
Well, speed is absolutely essential. Due diligence should not be an endless fishing expedition. Now, the time frame can vary wildly depending on the scenario.
Like how wildly?
Well, if you are dealing with a pre-pack insolvency, which is an emergency sale arranged right before a distressed company formally collapses, usually to save jobs, due diligence might happen in a matter of days or even hours.
Hours? That sounds genuinely terrifying.
It is extreme. The buyer gets a bare-bones list of assets, a list of staff, and they have to make an immediate judgment call with massive risk. But for a standard, healthy business acquisition like yours, you are typically looking at a comprehensive process lasting a few months.
Okay, a few months I can handle.
But keeping that momentum alive, that is partly the seller's responsibility.
Wait, my responsibility? I've given them all the documents. Shouldn't I just, hand the keys to my lawyer and my accountant, go back to running my business, and tell them to call me when the final contract is ready to sign?
That is another incredibly common trap. You cannot just disappear.
Why not?
Because your lawyer and accountant are dealing with the technicalities, but they don't know the day-to-day context of your business. When the buyer's lawyer asks a nuanced question about why you gave your biggest client a 10% discount 3 years ago, your lawyer won't know the answer.
Ah, all right.
They will have to wait for you. And if you are disengaged, the entire transaction just grinds to a halt.
Right. And if I'm slow to respond, the buyer gets suspicious. If I take 2 weeks to answer a basic question about my employee contracts, the buyer is going to start wondering if I'm fundamentally disorganized. Or worse, if I'm desperately trying to rewrite history before I send the file.
Precisely. Slow responses are a massive red flag that screams hidden risk. So the absolute best way to protect your deal, and honestly, to protect your own sanity, is to treat the due diligence Q&A as your top priority. Reply quickly, reply thoroughly, and keep the communication lines open.
That makes total sense.
The faster you give them the reality, the faster they can get comfortable with the risk, and the faster you can get to completion.
Okay. I think I'm going to drop the anxious business owner persona for a minute here.
You survive.
Barely. But looking at this whole process from the outside, the ultimate lesson for you, the listener, seems pretty clear. Due diligence is nothing to fear. It's really just the structural foundation of business. In fact, if a buyer came to me and didn't want to do any due diligence, I should probably be the one running away because they clearly aren't a serious or sophisticated operator.
Absolutely true.
A buyer who does it properly is a buyer worth dealing with. And the sellers who find this process the easiest, the least stressful, are the ones who prepared early, stayed organized, and quite simply, had nothing to hide.
That is an excellent synthesis. And to wrap this up, I'd like to address the listener directly with a slightly different perspective to mull over.
Oh, go for it.
We frame this entirely around selling your business to someone else. But what if you didn't wait for a buyer? What if you performed reverse due diligence on your own business this year?
Reverse due diligence, like aggressively auditing myself.
Exactly. What if you sat down with your own accountant and lawyer this quarter and used these exact same financial, legal, and commercial checklists? Look for your own black holes.
Oh, I like that.
Do you have uncollectible debts artificially inflating your balance sheet? Are your employee contracts legally sound? Do you have enforceable restrictive covenants in place? Is 60% of your revenue dangerously tied to a single client?
It's basically a stress test.
Exactly. Even if you have absolutely no intention of selling your business for another 10 years, finding and fixing those hidden vulnerabilities right now could drastically improve your profitability, your resilience, and your peace of mind tomorrow.
That is a phenomenal piece of advice. Don't wait for a buyer to tell you your house has a slow leak in the plumbing. Get the survey done yourself and fix it while the sun is shining.
Well said.
Thank you so much for joining us at the table today, listener. Take a hard, honest look at your own data room this week, long before someone else asks for the login. We'll catch you on the next Deep Dive.